Welcome to our next series of online macroeconomic lectures. In this particular series, we're going to be investigating some basic macroeconomic relationships. So this series follows our chapter on GDP, gross domestic product, as a measurement of economic output for a country. Then we talked about real GDP versus nominal GDP. We went into the difference between two ways of economic growth, two ways to measure economic growth, I should say. An increase in real GDP versus an increase in real GDP per capita. Then we talked about the business cycle, unemployment, and inflation. So now we're going to build on those concepts to build some basic macroeconomic relationships. And most of the ideas conveyed in this particular section can be attributed to a famous economist named John Maynard Keynes. Not spelled the way it sounded, K-E-Y-N-E-S, Keynes, who was a prolific writer around the time of the Great Depression and had many interesting and valuable contributions to macroeconomic thinking. So here are some of those basic macroeconomic relationships. If you remember back to our circular flow diagram when we studied this was the most complex, but we actually simplified it through our excellent study of economics. The circular flow diagram in the chapter on national income accounting, which broke down GDP, gross domestic product, into C plus I plus G plus X, and we traced that, and we said there's two ways to measure economic output. We said we can either add up all the expenditures on final goods and services, so the money spent on final goods and services, or the income generated by producing those very same services and goods, right? So there's two ways to measure GDP. Well, if you remember back to that diagram, one of the most important ideas I related back then was this idea of disposable income. So, if the United States generates, say, $15 trillion worth of economic output, how much is left over when it's all said and done? Because some income is received but not earned because we have to pay good old Uncle Sam taxes. So none of us like to do it, but we have to do it. So some income is earned but not received. Other income is received but not earned. Right? So that means if we think about Social Security benefits and welfare benefits and unemployment benefits, so we have to add those two together. Right? We come up with what's called disposable income. Right? So the easiest way to explain disposable income is simply, right, what's left over after we produce $15 trillion worth of goods and services? Do we have, say, $12 trillion worth to spend? So that's the income that flows back to households and is available for expenditure. So we call that disposable income. So that's the first term up there, income. It's important to understand an idea of DI, disposable income. Right? So after we've paid taxes on our money, we can really only do two things. We can spend, that's consumption, right? And we can spend on durable goods, non-durable goods, or services. And whatever we don't spend is savings to an economist. Now, whether you leave that in your checking account or in a savings account, or you buy a stock, a bond, you put your money in a mutual fund, you buy some currencies, you buy another house, right? Whatever that is, right? All of those are referred to as savings. Okay, so here are those relationships, and we'll get used to some of these initials here, right? And it's DI is disposable income again, equals consumption plus savings. And therefore, doing just a little bit of algebra, consumption can be easily calculated by taking disposable income and subtracting out savings. And of course, savings can be calculated by taking disposable income and simply subtracting out consumption. Well, it's very valuable when you study these. So we are going to use the ideas from the previous slide, disposable income, consumption, and savings, to introduce some important economic concepts. And these are referred to as the average propensity to consume and the average propensity to save, right? So the average propensity to consume is simply consumption over income, or what percentage of our total income do we spend, right? Average propensity to save is similar, right? Savings over income, or what percentage of our total income do we save, right? Now, it's always a good idea to use numbers to explain these ideas, right? So here I've just randomly pick these numbers to teach these points. Right? 50 would be 50,000. Okay, so 50, and that's income, right? So remember in the previous slide, 2 slides ago actually, we said income equals consumption plus savings. So here's our most basic of this economic relationships in its most basic form, right? So $50,000 worth of income, of course that's after-tax income, right? Assume we spend 40,000, then we save 10,000, right? So if that were the case, right, we would be spending 80% of our income, right? 40 over 50. So our average propensity to consume would be 0.8, 80%. And our average propensity to save would be 10 over 50 or 0.2, 20%, right? So notice this is important that the average propensity to consume and the average propensity to save will always equal 1 when added together, right? Here are those same relationships simply rearranged, right? $40,000 worth of consumption is equal to what? The $50,000 worth of income minus $10,000 worth of savings, right? $10,000 in savings could be easily calculated by taking the $50,000 worth of income and subtracting out consumption, right? So again, these two last ideas are extremely important here. Average propensity to consume for this particular individual, 8.8 or 80%. Average propensity to save, 0.2 or 20%. So for this particular person who earns $50,000 in disposable income after taxes, they spend 80%, they save 20% of their income. And notice once again, this is an important idea, the average propensity to consume, 0.8, plus the average propensity to save, 0.2, must always add up to 1 or 100% of your income. And it gets back to that basic idea that after you've paid taxes on your income, right, you really can only do 2 things with it, and that is consume goods and services or save. Now here are some of those same ideas, and I'm just going to bring everything up here and do this a little quicker. Right? We're just going to take a more macro approach to this same idea, right? In this case, the 10 doesn't represent 10,000. It's actually 10 trillion. So let's assume that there's $10 trillion worth of disposable income, right, from GDP. So $10 trillion worth of disposable income. Let's say that in total, this society spends $8 trillion worth of that income, and they save $2 trillion worth of the income, right? So there's your numbers, $10 trillion worth of disposable income, $8 trillion in consumption, $2 trillion in savings, right? Of course, we could express this the same way. How did we come up with the $8 trillion worth of consumption? Well, that was simply $10 trillion worth of income minus $2 trillion in savings, right? The next equation, $2 trillion worth of savings, was calculated by taking $10 trillion worth of income minus $8 trillion in consumption, right? But again, just like in the previous example, I used these numbers on purpose so that it would come out the same. The average propensity to consume for this entire society, and that's what we mean by on average, because remember, not every single person would be spending exactly 80% of their income, right? This is a more macroeconomic example, but on average, for this society, right, the average propensity to consume is 80% or 0.8 of their income, and the average propensity to save is 0.2 or 20% of their income. And again, average propensity to consume plus average propensity to save equals 1 or 100% of the total income. Well, sometimes, right, income changes, right? It goes up, goes down. Marginal, right? And remember, this is one of the most basic principles of economics anyway. Marginal thinking, economic thinking is marginal thinking, changes in the status quo. All right, so this is pretty similar to average propensity to consume and average propensity to save. But notice that our marginal propensity to consume and our marginal propensity to save, right, now we're calculating these statistics by taking change in consumption given a change in income. So in other words, if income goes up by a certain amount this year, how much of the additional income will that individual spend? Will they consume? And if income goes up, how much of the additional income will they save? And just like in the other examples of average propensity to consume and save, we're going to use some real numbers to clarify this exact idea so you have a better understanding of marginal propensity to consume and marginal propensity to save. So in the previous slides, we introduced the economic concepts of marginal propensity to consume and marginal propensity to save. So again, the marginal propensity to consume is the percentage of one's change in income that they spend, and the marginal propensity to save is the percentage of the change in income that one saves. And this is an important idea, just like when we studied the average propensity to consume and the average propensity to save. When you added those two together, the APC plus the APS, they came out to 1. The same is going to hold true here for the marginal propensity to consume plus the marginal propensity to save. In other words, whatever your given change in income is, you're either going to spend some of that and save the rest, or vice versa, right? So let's go over some real numbers here that will help clarify this idea. Suppose you had a change in income of $5,000. So in the previous example, when we introduced average propensity to consume and save, we talked about a person who was making $50,000 in disposable income after taxes. Let's assume that this same person now has an additional $5,000 in income after taxes. So an additional $5,000 in income. Let's assume that they spent $4,500, right? So that's consumption, $4,500 in consumption. Therefore, they saved the rest of the change in income. The change in savings was $500, right? So notice the $4,500 plus the $500, that's all of the change in income. And if we calculate marginal propensity to consume or marginal propensity to save, down bottom here you can see that for this person they spent 90% of their change in income. Right? Now how do we get that number? It's simply 4,500 over 5,000. Right? So change in consumption over change in income, that comes out to 0.9. And likewise, if the person saved 500 of the 5,000, right, the marginal propensity to save is the change in savings over the change in income. So 500 divided by 5,000 equals 0.1. Right? And again, 0.9 of the marginal propensity to consume plus 0.1 marginal propensity to save equals 1. The next example, similar thinking, but a macroeconomic example. Let's assume that the entire nation had an increase in disposable income of $1 trillion. All right, so GDP may have increased by, say, 1.5 trillion, but some of that was paid in taxes and such. So there's a $1 trillion increase in disposable income. Well, let's say that as a society, as an economy, as an entire country, of the $1 trillion increase in disposable income, we spent 900, and that's 900 billion. 900 billion in consumption, and Americans saved the other 100 billion, right, in savings. So it would work out to be the same, right? A marginal propensity to consume of 0.9. So 900 billion over 1 trillion works out to be 0.9, right? And again, 100 billion over a trillion works out to be 0.9, so 0.1 as well. So that's how we get our marginal propensity to consume and marginal propensity to save. Right? And important again that those two added together equal 1.